You are now listening to Nailed It, the Orthopedic Surgery Podcast.
Larry, welcome back, honestly, to the Nailed It Ortho podcast. So happy to have you back.
Yeah, I am very, very glad to be here. Different topic. Always good to see
Yeah.
you. And now you're out of fellowship, my man.
I'm out. I'm flying. The training wheels are off. I'm going now. I'm just pedaling.
That's it. So, a little bit more freedom, actually a lot more freedom, a lot less
Yeah.
supervision. And thankfully, since we're talking financial, bigger income. So that's a good thing.
Yeah. Yeah.
Relations.
And I'm looking forward to this episode. I honestly don't know too much about this topic, as I was telling you before we started. So I'll be learning some, and then hopefully our audience will be learning some. And we're going to talk about term life insurance. Honestly, just I don't even what is it? I don't even know what it is. I don't know the difference between the different life insurances. That's something that I know many other people in my position have put on the back burner. So maybe you can kind of give us some insight onto what this term life insurance is.
Yeah. And, a lot of times putting it on the back burner, there's a reason for that,
Yeah.
right? If you don't have anyone that's depending upon your income, you don't have a family history of, say, diabetics, right? There's diabetes in your family. You don't have it, but your siblings do or your parents do, and it hasn't hit you yet. That might make you think about, buying life insurance. But if you're just a single person, no one's really relying on your income, you don't have a family history. Yeah, I'd be surprised if you were actually thinking about it. So what is it? Term life insurance really is death benefit only. It's an insurance policy that you buy from an insurance company, typically through an agent, that says if you pass away, X number of dollars is going to go to your beneficiary or beneficiaries if you have more than one that you choose. And that's it. If you're with us, it's kind of like auto insurance. You have it. You hope that you're not going to be using it, especially if it's life insurance, because then you're not around. Money is going to go to somebody, else. Typically, the death benefit is going to be income tax free. Typically, they're going to get a checkbook or money is going to be wired into their account, income tax free. Once the death certificate is presented along with the claim form to the insurance company. But really, for lack of anything else, it is life insurance. It is a policy that pays a death benefit to your beneficiary in the event you are no longer with us.
So what's the difference between this term and whole life insurance, right? I thought life insurance is basically what you said, right? If you die, somebody gets paid,
Yes.
and so now when I, go to Google to prepare for this, there's like term life insurance, is this life insurance and all these different, I thought life insurance was life insurance. So what's the difference?
Yeah. So I'm going to use the umbrella permanent life insurance.
Okay.
And under the umbrella of permanent life insurance, yes, you can find whole life insurance. You might find something called variable life insurance. You might find variable universal life insurance, equity indexed universal life insurance, guaranteed universal life insurance, and different permutations of that. And really, as opposed to being death benefit only, this is a life insurance policy, so it has a death benefit component, but it also has a cash value to it. You can almost think of it as a vehicle where you can put money away. Yes, you're paying your premiums. First and foremost, you are buying death benefit, but it does have a cash value aspect to it. The type of policy usually differs of what is guaranteed and what's not guaranteed. And some people electively buy these policies as a means to put money away for an emergency fund, put money away to save for their kids' college education, put money away for supplemental retirement income. That's probably the most popular that I've seen. But as a whole, if you're a young physician, you're probably not going out looking for permanent life insurance. You're probably concerned, I have a family, I have people that depend upon my income, I have a mortgage. God forbid something happens to me. I want to make sure that I can leave money to my family so they can remain accustomed to the lifestyle in which I've provided to them. Pay off the mortgage, continued family income, pay for my kids' college education. That's really what someone is looking for.
Okay. Okay, that makes sense. And then so the different kinds that you mentioned, right? Like what would have you choose one kind versus the other? Like yeah, I know you mentioned you get some benefits and things of that. So what drives you to choose, I want to do the variable versus this versus that, like say for example, because we have a lot of young people that listen to this, but we have people that are married and in different situations. So what are some generic situations where somebody may go for one type versus another?
Yeah, I would say if someone is really doing everything else that they should be doing. So if they work for a hospital, they're taking full advantage of the retirement plans that are available. They're maximizing or taking advantage of the match. So this is kind of money that your employer puts away for you based on the fact that you're putting money away for yourself into a retirement plan. So this could be a 403(b) plan. If you're in a private sector, this could be a 401(k) plan. You are putting money ideally, into an IRA. There's something that is called a Roth IRA. Now, there are income limits to that, and you might find that a Roth IRA is being utilized for the most part by residents and fellows because they can meet that income requirement to be able to make direct contributions. There is something else, once you're an attending and you exceed the income requirements, or you're married to someone that's, say, not another resident or fellow, there's a two-step process that you can do to make yourself eligible to put money into a Roth IRA, but you can't do that on a direct basis. You're really doing it, in this two-step process to legally circumvent the income limits that exist for a Roth IRA. So let's say you've done all of these things. You have an emergency fund, you're taking full advantage of any programs that are available to your employer. You have a lot of extra money left over, and you really are looking for another place to put your money. Well, whole life insurance might allow for that because it's safe. It's chock full of guarantees. It's got a guaranteed death benefit, it's got a guaranteed cash value. The negative side is really going to be the upfront cost, especially when you compare it to the cost of a term life insurance policy. So remember, life insurance, for the most part, it's not for you. It's going to be for your survivors. So if you're looking at life insurance for something other than, I want to leave a death benefit to my survivors, maybe that would open up the door for another type of insurance. But I would submit that the majority of your audience or the majority of physicians really should be at the stage where they're trying to buy a large amount of term insurance to protect their families. If they love their spouse, that's great. That's really important. If they don't love their spouse and they're like, you know what, I probably wouldn't buy insurance. I'm really done with my spouse, but you have kids and you love your kids, you probably should look to buy term life insurance to protect them. Because if you're not working and you're not with us and your income has stopped, really your income that was going to your family has also stopped. So people will often say, but Larry, look at these numbers. Like I'm worth more dead than alive.
Yeah.
Well, that's true. If you're doing it right, you're really buying a stream of income that you would have derived had you remained living, and you're not living anymore. So we want to give your family this large amount of money so they have continued income. The college educations for the kids are paid off, maybe graduate school, and your surviving spouse can do just that. They can survive. And if you've had young kids, even if your spouse was working, do they really want to go back to work after they've lost their husband? Should they lose their mom too? Probably not. So that's going to drive you back towards term life insurance. And there's different types or different permutations of term life insurance.
And really quick, term life insurance, does it end after a certain age, right? Is it like, oh, where you're gonna be covered till you're 60 and then after that you gotta buy something else? Or, can you kind of go through that process?
Yes. So some policies are going to be renewable until your age of 80. Some you might find are renewable until your age of 95. But although term life insurance starts out relatively inexpensive, especially if you're a young, healthy individual, as you're getting older, term life insurance can get to be very, very expensive. And you will find that there's two types of term life insurance. So the first one is the one that I grew up on when I started in the industry. This was all that existed. And this was known as annual renewable term, or ART, or yearly renewable term, YRT. And what we would say is, well, Dr. Cole, you can go out, you can buy this $1 million policy, and you're going to see two columns. You're going to see a current, non-guaranteed scheduled premium. This is what we think we're going to be able to charge you based on what our actuaries are assuming for number of people that are going to die with this policy, rate of return that we think we're going to get on our investments, and what we believe our expenses are going to be as an insurance company. So if all of those factors are in line with what the actuaries are expecting, you're going to be paying this current scheduled premium. But then you're going to see another column that is called a guaranteed maximum. And the guaranteed maximum is typically a multiple of what the current non-scheduled premium is. So it might say in year one, the premium is scheduled to be $500, but it could be as much as $1,500. And when it renews, you don't really know what that cost is going to be until you get your renewal notice. So the big negative to this is if you're doing a budget, you're trying to figure out like, what's my affordability for life insurance? And you're looking at this schedule and you're solely focused in on the current schedule that's not guaranteed. And one or all of those factors are out of whack. And now it's moving the premium towards that guaranteed maximum. You might be in a surprise situation compared to what you expected. So now we get a little more current day. So shortly after I started in the industry, the insurance companies came out with what they called level premium term life insurance. And this is really, for the most part, the most commonly purchased term life insurance. And you can go out and you can buy a policy with a fixed premium rate. So this is where those two columns, the current non-guaranteed scheduled rate and the guaranteed maximum, are the same. There's no mystery. What you see is what you get. And typically you could find these with a 5-year fixed rate all the way up to a 40-year fixed rate, typically in different intervals. So 5 years, I will tell you, you don't really see many companies that have it. It might not even exist anymore. The most common are 10-year term, 15-year term, 20-year term, 25-year, 30-year, 35-year, and 40-year. One company actually has a custom term, and you can pick 10-year term, 15-year term, and anything that you desire from year 16 to year 30 in 1-year increments.
Okay.
Right. So if you looked at it and you said, well, I don't really want a 20-year term. That seems to be too expensive for me, but a 15-year term, it's not long enough. With this company, if you wanted to buy a 17-year term or an 18-year term, you could do that. So you've got flexibility there.
Now, when you get these terms or these different deals, it's the same premium that you pay yearly, and the payout is the same every year. I'm asking you, is it the same every year? And that doesn't take into account inflation or whatever else may happen, correct?
Correct. So if you went out and you said, hey, I'm a 35-year-old male, I'm going to buy $1 million 30-year term policy that will basically take you up until the age of 65, the $1 million death benefit remains that way. Now, when the guaranteed level premium period is over, one of two things happens. So let's say at age 65, in my example, the death benefit is going to drop tremendously and the premium is going to stay the same, or the death benefit is going to remain the same. The premium is going to absolutely skyrocket, and each year thereafter, it's going to continue to go up. So if you're going to guess, and you're going to guess wrong, I would say go on the more conservative side and buy a larger amount than you think you might actually need to make up for some type of inflation. Now, a good general rule is my life insurance death benefit should be somewhere between 7 to 10 times my gross income. So let's say 10 times. So if I'm married, I have 2 kids, and my income is $300,000, I should probably be looking somewhere between $2 and $3 million of death benefit. You can get more scientific. You could say, well, I know how old my kids are. I'm going to assume that I want to send them to a public school or a private school. I know what my mortgage is. If I assume that I'm not going to refinance and I die tomorrow, because we always have to make that assumption, I want to make sure that mortgage is paid off. I know I would like to leave an annual income of X to my spouse for X number of years. And then you could subtract out the assets that you already have to come up with this number. But I tend to think it's a lot easier to say 7 to 10 times my gross income is probably a good number. You can actually go online and you can Google life insurance needs calculator. You'll find a ton of them, and it'll basically ask you, Wendell, tell us what you've got. Tell us what you would like to leave behind. We will do the math for you, and we will tell you the amount of death benefit you should be looking to purchase. But remember, it's kind of like what you put in is what it's going to generate. So if you say you don't want to leave a lot and you have a lot of assets, probably going to give you a low number. If you say I want to leave a lot and I don't have a lot of assets, it's probably going to give you a pretty large number. The insurance companies will not just sell you whatever you want. It's going to vary based on your age, and it's typically going to be a multiple of somewhere between 20 and 40 times your gross income. So gives you a little bit of a background as to how they do it.
Oh, okay. So let me make sure I understand what you're saying correctly. So the insurance companies now, you should get at least 10 times the amount of your gross income, correct? But now some of the companies, they'll probably sell you insurance, or they'll sell you plans where you're getting 20 times or more, 20 to 40 or however more than the actual income. And nowadays that's like a normal number, right? So if our listeners are, they're like, actually, I want to get this, and they get these numbers where it's like 20 to 40 times as much, they shouldn't be alarmed. That's kind of a normal thing nowadays.
I would say the 7 to 10 is probably the most normal. If they're using a needs calculator, it's garbage in, garbage out. But I would say pretty good rule of thumb is 7 to 10 times gross income. So if someone's earning 300,000 and they came to me and they said, Larry, I think $3 million is my number, I would say, yeah, that sounds, pretty reasonable. If you're married, you have 2 children, you have a mortgage, you want to pay for their college. Yes, if they said to me, I really think 3 million is a little low, I'm thinking more like 5 million, I would not say that that's a crazy thing. If they came to me and they said, I need 15 million, I would say we probably should talk about this. How are you coming up with that number?
Right.
What are your intentions, with this? But the insurance companies will not let you buy so much insurance. They are going to look for, what's the need for this? If you told them that you have a big inheritance coming in, or you have a disabled child or something like that, that will factor in. And the insurance agent, if we know that things are not typical path, we will put a cover letter in with the application to the underwriter and say, hey, this person is applying for this amount of coverage. I just want to give you an idea of what their family situation is, how we came up with the need for this, what this individual is trying to accomplish. And then they'll look at it and they'll say, okay, this is financially justified. This makes sense. If they don't think that, then they'll come back and say, hey, at this person's age, the maximum that we're willing to issue or sell to someone is this amount. So one thing that you find with residents and fellows, and let's say that they're not graduating, you have a orthopedic surgery resident, they're a PGY3, their income is, high end 90,000, low end 60,000. They could probably buy 2 million, maybe 2.5 million of coverage. If they start looking for beyond that, the underwriter is going to say, this doesn't make sense. Like, even though
Yeah.
we know your income potential is substantially higher as an attending, you're not there yet. We're not looking to give you this amount. We don't want you to become like a target on your back. So
Right.
that's why they do it. Now, here's what I find to be really interesting, because cost definitely factors in. And this is kind of a good segue to, why would someone buy term insurance
Yeah.
versus, let's say, cash value insurance? So
Perfect.
let's say we use three different levels. We go out and we say, let's look at a 10-year term. So this is, remember, just a fixed rate if you're 35, fixed rate from age 35 to 45. If I wanted to buy that annually, it's about $225 for the year. It's pretty inexpensive.
Yep.
If I go to a 20-year term, same $1 million, but it's going to last 10 years longer, it's about $360 annually. So a difference. Monetarily, it's not that big. Percentage-wise, it's pretty big. And if I go to a 30-year term, it's about $610. So the first thing that we see is, really, every time you go up a 10-year increment, for the same premium, you can buy about half the death benefit. So if I told you, Dr. Cole, today's your lucky day, $1 million policy for 10 years is $225. Well, if you're like, 10 years, I could blink my eyes. That's over. I don't know what my health's going to look like in 10 years. I should probably get longer. For really the same premium, it's not going to be $1 million anymore. It's going to be 500,000. If you go to 30 years, it's not going to be 500,000 anymore. It's going to be more like 250,000. So
Mm.
when it comes to term insurance, I will tell you, when I first started in the industry, I would have my clients tell me, but Larry, you don't understand. I'm an orthopedic surgeon. I'm going to make a substantial amount of money. I'm not going to need life insurance in 10 years. Just give me a 10-year term and I'll be done. Well, can you imagine what happened 10 years later? I went back to the same client. They were making substantially more money because they finished their training.
Yep.
They have a bunch of kids. Their lifestyle has increased. They have a home. They don't own it. The bank owns most of it. I tell them that their life insurance policy is going to expire from the level premium period. And they come back and they're like, oh my God, Larry, are you kidding me? It's 10 years out. I've got a 2-year-old, a 4-year-old, and a mortgage. I need my life insurance. So
Yeah.
now they're 10 years older and they're going to answer medical questions again. They're going to potentially do an exam, blood test, urine test, and they're probably not going to be in the same health that they were when they were 10 years younger.
Okay.
So personally, I am not a fan of 10-year term. It goes by too quick. I've seen too many people buy it. They close their eyes. It's over. The need is not over, and they're back in the marketplace looking to buy more. What I am a big fan of is 20-year term, 25-year term, 30-year term. So hold on to your hat. This is about as complicated as it gets.
Let's go. Let's go
All
for
right.
it.
So let's say that we came up with the need and we said, okay, Dr. Cole, you need $3 million of death benefit.
Mhm.
If you had no kids, you were not married, you just know, I want to get this done. I'm young, I'm healthy, I'm 35. I want to lock this up until the age of 65. I would probably say you should think about a 3 million 30-year term, lock it up, throw away the key. You're good for a very long time. If you have a child, that's going to get them out of college. If you have another child, it's going to get them out of college. You're really going to be in pretty good shape. But if you're coming to me and you're like, I'm married, I have 2 kids, I have a mortgage, I kind of know what my financial life looks like. I am doing financial planning. Maybe I'm doing it on my own. Maybe I work with a financial advisor, but I have an idea of what my finances are going to look like. You could do something that's called laddering your coverage. Sounds very fancy.
Laddering your coverage.
Yep.
Okay.
And what laddering your coverage is doing is, you're literally just buying different policies typically from the same company, with different durations of a guaranteed level premium. And because of this, we're going to be able to take advantage of the fact that the shorter term durations get you a multiple of the death benefit of a longer term duration. So typically you can buy twice the amount of 20-year term for the same premium as half the amount of 30-year term. So if I went out and I did some research and I was a person living in New York, I was a 30-year-old, very healthy male, I could buy a $3 million 30-year term for about $1,700 a year. It's fixed for 30 years in my example, from age 30 to the age of 60. If I see I don't need as much coverage for as long, I could reduce the death benefit. They're not asking me any questions when I reduce. If I want to buy more, yes, I have to buy another policy to supplement this and answer my medical questions and do an exam, blood test, and urine test. And it's going to be based on my age at the time I'm buying more. To get more financially savvy, I could say, well, you know, Dr. Cole, you're an orthopedic surgeon. You're going to be working, earning a substantial income for a long period of time. If you're managing your finances in any real way, and you're taking advantage of these employer-sponsored plans, and you're reducing your taxes, and you're saving, your need for life insurance as you save for your kids' college education and your retirement and you pay down your mortgage, that's actually going to go down. So in the earlier years, that's when your family is really at the most risk because you've got the most to lose. So what if we did this? What if we bought $2 million of 20-year term? And I could tell you that's $644 a year. And $1 million of 30-year term, and that's $610 a year. Like I said, it's a 2-to-1 ratio. Now I'm paying $1,254 as opposed to almost $1,700 per year. If I die in the first 20 years, yeah, everything pays. 2 million, the 20-year term pays. The 1 million 30-year term pays. My family gets $3 million. But if my wife and my kids don't kill me and I make it 20, the first 2 million drops off. I'm no longer paying that $644 premium for that policy. That's gone. My million of 30-year term that now has 10 years left on it because I'm 20 years in remains. At the end of 10 more years, that goes away. I ideally can now self-insure. And that really aligns well with my financial plan. So this laddering strategy is super, super popular because it will save you money up front and allow for the same death benefit at a lower cost. And we see that this was almost a third less expensive doing that combination of 2 million of 20 years and 1 million of 30 years, as opposed to a straight 3 million. Now, you could buy a straight 3 million, and if you see your needs are changing, you can reduce that. So in that case, you're not getting the savings up front. You're hoping to take advantage of the savings later on.
A little bit later. Yeah.
You know,
well,
so,
that's good. Yeah. I never heard of why, I don't know much about the about the term life insurance, but no, that's good to know about laddering. And I like that example that you just said where you do, for example, a 2 million 20-year, and then you also add a 1 million for the 30 years. So you get a total of 3 million, and then you're getting the savings up front, like you just mentioned. And then if something changes down the line, you still have the, at 21 years, you still have your other policy, your $1 million policy that you got, and your needs may change over time, right?
Yes. And you might find that if you're a healthy person and you've got a family history and you're like, I don't really have dependents now, but I feel really good. And even though there's diabetes in my family, it hasn't hit me yet. You can go out and buy a 30-year term now. And as you have kids and as you have other people that rely on your income, you can always buy additional policies at a later point in time. The negative is you have to go through that underwriting process, and you'll be a little older, and you're still doing laddering. You're just doing it in 2 different time frames as opposed to doing it up front. So the laddering makes sense. If someone's life is kind of predictable, the laddering works better. It doesn't really work so well if you're like, I'm not married, I don't have kids, I don't have a home, my whole life is completely unpredictable, then I would say you probably want to go with a longer duration term and then add to that later to build that ladder.
Wow. Well, that's good. No, this was great, especially getting the overview and learning about these different types of, insurances, and then different plans. And I really like the laddering too. So I hope those who are listening to this took notes during that or goes back and re-listens to it again to understand some more. But anything else you want the people to know, about this, term life insurance before we wrap up here?
Yeah, so I'll say there's a couple of riders, and just like we have them on disability insurance, a rider is
Yep.
like an extra piece that you can add to your policy. So there is something that's called a waiver of premium rider, and you can almost think of this as like a little disability insurance policy to waive the cost of the life insurance premium.
Okay.
Now, if your goal is to convert or switch from a term insurance policy to some type of permanent insurance policy, this might be a good thing to have. That way, if you're disabled, the policy will actually continue without you making the premium payments. But if your goal is not to have anything other than term insurance because you believe that your money can be put to better use elsewhere, I probably would not buy a waiver of premium rider. So I'll give you an example. On our 20-year term, we saw without a waiver of premium rider, $1 million death benefit. We're going back to our 30-year-old in New York. That was about $360 for the year. If you add the waiver of premium, it's about $500 a year. So think about this. It's $140 and the death benefit is $360. That's about 39% of the cost of the death benefit itself. If you have adequate disability insurance, I will submit to you, you do not need a waiver of premium rider on your term life insurance policy. The definition is not like it is on a disability insurance policy, right? Ideally, your disability policy says if I'm an orthopedic surgeon and I can no longer work as an orthopedic surgeon, full benefits are payable.
Yep.
Here, in your best case scenario, it's going to say something like after 6 months of being disabled, if you can't work as an orthopedic surgeon, we're going to refund the 6 months that you paid in your premium. And typically for the next 2 years, although it could be longer, we're going to continue to waive that premium if you can't work as an orthopedic surgeon. But after a limited period of time, the definition changes. And it says, oh, Dr. Cole, if you can no longer work as an orthopedic surgeon and you cannot do anything reasonable for you based on your education, training, and experience level, of which you have a lot, we'll continue to waive the premiums. But if you can do something based on your education, training, and experience level, you have to start paying again, which goes back to the waiver premium rider, in my opinion, can be expensive. It could be a large percentage of the cost of the death benefit. And I would say you're better off taking the cost of the waiver premium rider and using it to get more own occupation disability insurance. Because if you're disabled and your annual premium is $360 a year or $600 a year, or hey, even $1,700 a year, it's not going to be very difficult for you to come up with that if you have disability insurance. And even if you don't, you could probably come up with that pretty easily.
Okay. Okay. No, that makes sense. And again, I'm glad you're explaining all these terms because I've never heard of any of these terms. But that rider, that's good to know about. Yeah, no, I thought this was very informative, and every time I speak to you, I always learn something new.
I'll leave you with this. And this kind of goes
Yes.
back to your question about, why would I not want to have some other type of policy? So
Yep.
this is a well-known life insurance company. And I just ran the numbers for same $1 million,
Yep.
same 30-year-old in the state of New York, great health. The annual premium is $1,345 for $100,000 death benefit. The
Okay. I see that.
$1 million death benefit for this 30-year-old is $12,550. So think about it. This is $1,000 a month for a $1 million policy, where we looked at a $1 million policy for 30 years. was $610. So
And why the big discrepancy?
it's really that it's going to last forever. They call it whole life because ideally it's going to last for your entire lifetime. It's going to build up some type of a cash value. So there are certainly potential benefits to it. But for people that are young, that are not taking full advantage of everything else that they should be doing in their financial lives, I find it very hard to make an argument for this. Why would someone want a permanent death benefit? Like, why would someone want more than term? Without getting too deep into it, I would say number one is that they've got a disabled child, and that disabled child is going to outlive the person that is actually working and that is taking care of them. So they probably need a death benefit that's going to last forever, right? As long as possible. If they want to leave money to charity, there are ways to use life insurance to leave money to a charitable organization. Like I know the Orthopedic Surgery Society actually have something called OREF, right? OREF.
Yeah. Yep.
You can use life insurance as a way to fund the research educational foundation. And then if you're super, super wealthy, then this is way beyond the scope of this podcast. But let's say, you're married, and currently the limits for a married couple are $19 million. But let's say that between the two of us, we're married, we've got much more than that. We've got $30 million between the two of us. There's something called an estate tax. It's not due upon the first death, which would be me, but upon your death, let's say we were over by 11 million. Well, we know that 40% of that overage is going to go to the government for taxes.
Yep, taxes, yeah.
The balance is going to go to the kids. If you look at it and say, well, look, I would rather leave more money to my kids after my demise, we can buy a special type of insurance policy that insures both of us. It does not pay upon my death, the first death. It pays upon your death. It's typically owned by a trust, which is an entity. And then the trustee basically uses the money to buy assets. All that you really need to know is if you're very, very wealthy, you can use life insurance to pay the taxes with discounted dollars. But again, way beyond the scope of this.
I mean, I'm sure we still have some attendings that listen to this, so I'm sure there may be the 0.1% of the people that listen to this podcast, but I'm sure there's somebody that statement may have piqued their interest a little bit,
Yeah, and in the old days, before the exemption amount being as high as it is, it was much, much lower, and it was really not uncommon to find, your surgical specialists or your internal medicine subspecialties, buying, this was what's called a second to die policy or a survivorship policy. It was very common, but since the limits are so high now, you really don't see a lot of people implementing this strategy unless they're extremely wealthy. Now, one thing that you could do is, even if you're not extremely wealthy, but you're afraid that these limits might go down in the future, you could buy your term insurance and have it owned by a trust. And if you do this, it basically makes the death benefit not only income tax free, but estate tax free. So if you're buying a substantial amount of life insurance and you're concerned about this, then we can talk about an irrevocable life insurance trust, or you can go back to your estate planning attorney and tell them, I'm thinking about buying a large life insurance policy. Should I have an irrevocable life insurance trust be the owner and the beneficiary? And then get into that discussion.
Yeah, I feel like this goes levels and levels deeper.
Yes. As a whole,
levels deeper.
I would say keep it very simple. Just know term life insurance is not for you. It is for your survivors.
Yeah.
If your income is something that other people depend upon, you need it. If you love your spouse, you probably need it. If you hate your spouse and love your kids, you probably need it. The best thing to do is to go online, do a little bit of research, speak to professional, agents. We can walk you through this very easily. And as you saw, term life insurance really is very relatively inexpensive.
And Larry, where can the people listening to this podcast, reach out to you, or, if they want to learn some more about this or speak to you?
Yeah, so very easy. Email is lkeller, L-K-E-L-L-E-R, at physicianfinancialservices.com. My website's physicianfinancialservices.com. And you can certainly feel free to call with any questions. It's 516-677-6211.
Larry, again, thank you so much for coming on the podcast. It's been a pleasure having you on again.
Awesome. I appreciate it. Hopefully, we didn't get anybody too lost towards the end. Stick to the basics and just know, if the income is substantial, if you've got a large family and you plan on buying a lot of term insurance, something to think about is this life insurance trust.
Yeah, yeah. No, that was I like that. The irrevocable. Hold on. The word you said.
Is
The big word start with IR.
Irrevocable
Irrevocable trust.
life insurance trust,
Life
or
insurance.
we love acronyms. It's not just for you guys in medicine. ILIT, ILIT.
ILIT. I like ILIT. That's a good
There
one.
you go.
All right. Thanks again, Larry.
Thank you, sir. Always a pleasure. We will chat again shortly.